Hey everyone, welcome back to Yuri's Box. In this video I'll be talking about the S&P 500. If you like this kind of content, consider leaving a like and subscribing to the channel. And as usual, nothing in this video is financial advice. So I'll be really talking about the S&P 500, especially when it comes to history and some potential examples we can point towards to better orient ourselves in these, wicked times. All right. So I think the first place the place to start off with is really the tariff drama, because prior to, in the lead up to April 2nd, I still have these up. I pointed out, these various scenarios. All right, April 2nd might be a dud. We might not get tariffs. We might get a further delay on tariffs, and we might also get tariffs put in place with two other scenarios. Being 3A, low tariffs, so kind of a benign outcome in the short term, but the potential for those lower tariffs, well, relatively low, because again, even 10% isn't low by in relative terms, but again, low. So a benign outcome could be good in the short term, but it could be worse in the long term, because it would mean that we're treating tariffs not as a bargaining chip, but as a source of revenue, which would not be great. 3B would have been the worst outcome in the short term, with higher tariffs, but those higher tariffs being used as bargaining chips. Now, we actually got, and in the immediately after, in the week after, I pointed out how we might get, some kind of a pause for allies and maintaining that 10% baseline, as you leave room for negotiations. But in reality, 3A and 3B have both occurred, and what I'm referring to as 3B was the so-called reciprocal tariffs, the cardboard that Trump had during his press conference. And that, you could argue, that was probably the bargaining chip. But 3A, given what we've seen in the UK trade deal that came out on Wednesday, we've actually maintained that 10% baseline. So we actually now have to deal with the fact that, tariffs aren't only the boogeyman. I mean, it's structural. It's potentially the Trump team is treating them as a source of revenue for whatever else they want to do. Tax cuts, I don't know. It'll be up to them. And with time, this will be another headwind to the S&P 500, in my opinion, because again, it's just a tax hike at this point. All right, it's gonna hurt profits. That's the way I'm going about this. It is also this morning's news that some of the talks so far, I mean, things could easily change in the next, however minutes I decide to make this video. But actually, China and the US the talks between the two have broken down. Witnesses have said that the talks in Geneva have actually been abandoned by both parties. Again, not great. It just plays into the theme of everybody kind of dragging their feet and exacerbating the negatives of this tariff drama. So again, we still have to deal with the tariffs, right? And that will be a headwind. At the same time, though, I am sympathetic to the idea that the craziness, all right, all of the crazy headlines that we saw on, between April 2nd and April 15th, more or less, that's kind of behind us at that point. So you have to consider both things. Yes, the craziness is behind us, but we still have to deal with the fallout of all of this. So I would consider that. I could also consider the geopolitical risk, because we do have rising tensions between India and Pakistan. Now, I wouldn't put too much weight on this because, again, this is kind of like the bear doomsday scenarios that, just keep it in the back of your head. Consider that if things continue to deteriorate, and depending on how far they go, things could get a little bit more messy, and for the S&P 500 as well. What I've also said about the S&P 500, really starting around here, these two candles right here, I was sympathetic. Actually, it was this candle right here. I was sympathetic to the idea of seeing the S&P continue to rally and actually see some follow through off of the bottom right here, and potentially I indicated an area between 5,700 and 5,800, which is basically the line, well, the bull market support band, basically. Now we have basically tagged 5,700. Would I be surprised if we actually do see some follow through? Because again, something that I'll remind everyone again is that stocks behave in one of two ways. They either have to price in a recession because the sky is falling and it's the end of the world, and so we have to go down by 30, 40, nearly 50, 60%. Or we're not in that environment and we can go up. So either stocks really have to price in a recession, or they can climb the wall of worry. Simple as that. So again, right now, we're not in an environment where, again, I've said many times, we're not in a depression, we're not in a recession currently. We might be, but again, we don't have any clear, definitive indication, or rather, we don't have anything slapping us in the face, all right, that like negative payrolls. Initial jobless claims are above 300K, or at the very least 250K. If we are in a slowdown, okay, but that's not a good enough of a reason for stocks to price in a recession. I am personally in the camp that will eventually occur, because I do believe that we will get some kind of a resolution, all right? Some kind of a landing, I don't know. But I do believe that that's where we're headed. And in the meantime, between where we are now and the landing, there's kind of an air pocket, all right? And it really all depends on the headlines and the data, all right? So keep that in mind as well. Again, would I be surprised if we continue to see some further upside, perhaps, we actually go up to 5,800, perhaps. All I know is that, especially this candle right here, was kind of discounting a lot of good news coming out of trade talks. Now, if we continue to see this, the breakdown in trade talks, like potentially we saw this morning, I wouldn't get married to this rally. Could we see some further upside action? Definitely. But given that most of it is basically, pricing in good news on tariff talks, on trade talks, if trade talks don't go well, I would start to ask myself a few questions. So I maintain the cautious outlook on stocks. I mean, we could definitely see some follow through. However, given that it's mostly headline driven, and we still haven't really considered the fallout from the tariffs, I would not get married to any rally. And I would actually try to diversify, again, not financial advice, but at this point, I would look to other options rather than, basically the Mag 7. And so that as far as today is concerned, all right, I continue to maintain that cautious outlook. Could we see some follow through? Absolutely, but I wouldn't get married to it if we do. We have bounced off somewhat off of the bull market support band. Would I be surprised if we see a rollover? Right, given the fact that we basically retraced all the way up to April 2nd, and this is where we're stalling out for the moment. We could see some downside, especially given the fact that we've seen the trade talks break down as of 2 p.m. right here. So we'll see about that. Now, what I really wanted to talk about is history. And I won't be talking about our beloved 06-08 cycle, because again, that is pretty straightforward. I've spoken about that many, many times. And this is actually what would occur in the case of a landing. All of a sudden, stocks are faced with the prospect of a recession, and they have to price it in. All right, now, potentially, would we see a 57, 58% decline? I don't think it would be that dramatic this time around. I think that by the time we're down 30, 35, 40, at that point you would see, the zero bound, you'd see QE, you'd see government response, the whole shebang that, we're used to at this point. And so I would think it would limit the downside on stocks to about 40, 45%, 50 max. But again, we're talking about some pretty dramatic at that point in the case of a hard landing. And coincidentally, on TLT, I would actually think that the fact that we will get a massive response in the face of that, I don't think there is much upside over 135. But again, that is for another video. So again, we won't really be talking about 2008 because again, it's a pretty straightforward example. All right, if a hard landing is imminent, it is slapping us in the face. Expect stocks to have to face that and face the music. Three examples I want to talk about is 1998, 1995, and 1973. So 1998 is often talked about mainly because from this local top right here to the bottom, it was about a 22% decline. And if you go back to today's decline was about, 22%, not too dissimilar from, again, what we see today. Also, 1995, which is, again, the second example, but most importantly, it is the only example of a soft landing that the Fed managed to stick, and this was about a 10% decline. All right. And why is this why do people look at it? Because again, we did see a decline, and again, probably the most relevant example is 1998. We did see a decline, but after that, we saw further upside in the market. This was about a 66, let's be generous, 66% rise, which, if you're curious, puts us at 8K. Exactly 8K. Now, I know that saying 8K on the S&P 500 might sound ridiculous, but I wouldn't discount it. Anything can occur. We could definitely be in the kind of fun blow-off top phase, and that which leads us up to 8,000. Who knows? Definitely. The key difference between today and 1998, and arguably even 1995, is really the economic backdrop. And again, I'll try to keep this video quite simple, so I won't be bringing out a lot of indicators and examples. I'm mainly going to be looking at the unemployment rate. And as far as 1998 is concerned, the main difference is that during 1998 and actually 1995, during the soft landing, the unemployment rate was on the downtrend. While we did have some kind of a scare, yes, that inflation was, the unemployment rate was starting to move up. Another way you can look at this is via the people being unemployed for 26 weeks and over. Again, we kind of bottomed out in 1995 and potentially started to see some hint that we might get, unemployment going up, but it just went on its merry way. All right, same thing for 1998. The unemployment rate was going down. We were still in a fairly strong economic cycle, which eventually ended in 2000 and 2001, and we peaked out on the 27 weeks and over unemployed at 2.1 million. Today, we have the exact opposite. Unemployment has bottomed. All right. Still have Nick Tamaros up. Unemployment rate bottomed in March of 2023 at 3.4, and we've actually been on the uptrend. Now, has it been a dramatic uptrend? No, absolutely not. But again, as far as the economic backdrop is concerned, we aren't in a phase where the economy is expanding, or is in let's call it the boom phase, whether it's near the end of the boom phase. But regardless, the unemployment rate was on the downtrend in 1998 and 1995. Right now, we're in the opposite direction. The direction of travel for the unemployment rate is up. Now, it doesn't mean that we'll be at 7%, 7.5%, 8% by, June or July or August. But regardless, the direction of travel for the unemployment rate is up, not down like it was in 1998. And I think that this is a very, this is key when talking about the two examples, because we know that, and I've talked about this many, many times in my videos, that, whether you look at the quits rate, whether you look at the regional surveys, the PMIs, the ISM reports, they all kind of point towards the same thing. A darkening economic outlook, new orders faltering, production, still hanging in there, but if you know where you're going, meaning slower growth and no new orders coming in, that doesn't really serve to. It doesn't really describe a booming economy. It describes a slowing environment, which leaves the economy fragile, potentially susceptible to some kind of external shock. So again, we could very well be in a 1998 scenario where we get. Actually, now that I look at it, we kind of do have similar dynamics to 1998, because again, the first bottom, then we go back up, and then we actually sweep the previous low. It doesn't look too dissimilar. Okay, the first low right here, then we retrace. Could we see a sweep of the previous low? It would be something to keep an eye on. I wouldn't completely discount any scenario, and again, that's why I maintain my cautious outlook. Not doomsday, but not ultra bull. All right, I'm stay on my feet. For the time being. The last example I want to talk about is something that gets pushed around a lot. It gets put out a lot. A lot of people like to talk about it. Especially, I remember, on X or Twitter, if you will. Every time we were here in 2023 and 2024, every time we would see the inflation rate kind of tick up a little bit, immediately we would get people posting the overlaying the charts between this cycle's inflation and the inflation we saw in the 1970s. So you get the first wave up, then it kind of bottoms out, you have this kind of a flag right here, and then you have the second bout of inflation. Again, a first peak, then you kind of have this flag. Again, you probably have to ignore these reads by here, but regardless, this is a very popular example, especially when it comes back to the stagflation narrative. And during this time, you actually had, we'll call it a megaphone pattern, whatever you want to call it. But regardless, from 1973, where are we? Right here, 1973 to basically, 1974, we saw a 50% decline. And typically, the 1970s are famous for the stagflation, right? So bad growth and high inflation. But it is actually a little bit nuanced than that. For example, let's look at the unemployment rate. So from 1970 till 1973, unemployment was going down, right? And it actually bottomed in October of 73 at 4.6%. At the same time, from 1973 from 1970 till October of 1973, inflation was going up. Yes, it did have a dip, but it was going up. So we had a situation where unemployment was going down and inflation was going up. But by the time inflation actually went up in its up move, right here, rather, by the time the unemployment rate started moving up and actually peaked in April of 1975, inflation was already on its merry way. But right here in April of 75, it was already on the downtrend. And the most important thing that you have to pay attention to when looking at this right here is two things. First of all, the backdrop that we had leading up to 1973 is quite different, because again, while we did have inflation misbehaving, we also had unemployment going down. All right. Today we have unemployment going up. Point number two is that by the time the unemployment rate peaked, inflation was going down, and it actually finished lower than what it was in 1973. And I think that is something important to remember, because, and again, focusing on this cycle right here, without going till today, what mainly caused this right here was oil, right? The trade embargo by the Gulf states, because again of the war with Israel and the fact that the US sided with Israel, as a kind of vendetta. We had oil spiking up by, old coin level of spikes. Okay, I think let me see if this is the chart that goes back. No, but regardless, most of this move right here in inflation was caused by oil. And even then, by the time the recession was over, all right, inflation was lower than when it started. Okay? And that is key, because the lesson there is that if you get to a point where, the unemployment rate goes up, you basically get to a point where you don't really have an economy that can cause inflation. It's dead. It's a done deal. And, I can't help myself but, call 2008 into question. This is kind of a similar mechanic that we saw again in 2007, 2008. While we did see inflation move up until 5.6 in July of 08, and keep in mind, we had Bear Stearns right here in the middle in March of 08, and Lehman Brothers was 2 months after this. That didn't stop inflation going to 5.6. But the secret sauce is that it dropped like a rock. So even if we do see, and I can kind of see the stagflationary trade take hold currently, like, you can see bonds kind of take a beating, all right, as if we are in stagflation. You can kind of paint that picture, because again, we have a slowing economy and we have the fear of inflation. So you kind of put those two ingredients together, you can kind of get the picture. But eventually, when you get to the recession, when you get to the bad side, meaning the unemployment rate starts to go up and up and up and up and up, inflation drops like a rock. All right? And we saw this in 1973 as well. Now, granted, we also had oil misbehaving. We had, the Arthur Burns head of the Federal Reserve at this point, which was, kind of being probably a little too reactive, when looking at the Fed funds rate. Let's see. Actually, this goes back to 1973. It actually does. And so again, you can see these wild swings, just continuously reacting to it, and eventually it took Paul Volcker, but that's a whole different story to rein in inflation. But regardless, what did that mean for the S&P? Basically, the 1970s were a time where the S&P didn't do anything until basically in 1982, when you could quite honestly say that 1982 was the year our current bull market began. All right. So again, if I had to put everything on a scale, I would say 1998 is kind of the bullish outlook, which is definitely possible. I would tend to discount it because of all of the, where we know we're going in relation to, the economic backdrop. Again, it's the opposite than what it was it's the opposite today compared to where it was in 1998, with the unemployment rate going up today when it was going down in 1998. So I would keep that in mind. The same thing for 1995. And actually, same thing potentially for 1970s. We were in a position where we had the unemployment rate going down in the lead up, while inflation was starting to misbehave. And when the unemployment rate spiked, that actually just killed inflation, right? It went down to about 4.9%, which again, I know saying that, it killed inflation when it brought it down to 4.9 is kind of an overstatement. I can hear you laughing, but, regardless, we were at 12.3, all right? Just a really rough, measurement here. That's basically it. So the moral of the story, again, I think that I maintain my outlook that the 1970s stagflationary environment is relevant only for the present. Meaning that as long as we are in this environment where we don't have a recession yet, so we have just slowing growth and the fear of inflation, we definitely can see a stagflationary narrative take hold, like I'd argue we've had. Just look at bonds, for example. I think bonds are quite a good proxy for that. But this stagflation narrative will only hold as long as we have the slowdown. The moment we get into the hard landing, potentially, or some kind of a resolution, I don't know, but let's just call it a hard landing to keep things simple. Stagflation will be off the table, and we will be reacting to growth, just nosediving at that point. And we'll get all the stimulus. We'll get probably potentially rates going low and low and low and low, and all the government reaction to that. So hopefully this kind of helped put everything kind of in the right context, because I do see definitely 1998 be talked about quite a bit, but I do think that we can't ignore this fact right here, that the unemployment rate was going down. We were still in an economic cycle that was still expanding, as opposed to today where the unemployment rate has bottomed out. It's been 2 years, and the direction of travel in the unemployment rate is likely up, in my opinion, from this point on. And that is something that we can't really ignore. However, as I said in many of my videos before, as well as this video right here, just because we're in a slowdown doesn't mean that stocks can't go up. I would just be extremely cautious of capital allocation at this point, because in my opinion, I can see where we're going, and stocks haven't really even begun to price in any of the potential, really the potential of a hard landing or a landing or soft landing, some kind of a resolution. And so that leaves stocks quite vulnerable, in my opinion. But again, regardless, as long as we are in an environment where growth is slowing and it continues to feed into this kind of stagflationary environment, I wouldn't be surprised if we do see some follow through on this rally right here. On the flip side, as I said before, the problem with these candles right here is that a lot of it came on the back of a lot of optimism with in regards to the trade talks. And if the trade talks kind of break down, that doesn't really bode too well. Okay, so I wouldn't get married, is what I'm saying, to any rally right here. I would look to other areas of the markets, potentially hold a more defensive posture. I think the time to be a cowboy and go along and just buy stocks and forget about it, that was right here, potentially even October of 2023. I think that most of the move is done. Could we see some dramatic blow off top? Absolutely. Just a little tidbit I can give you is, imagine bond yields going lower. That provides kind of, let's call it quote unquote easing for the market. Could the fact that potentially, let's say, that bond yields go lower be a reason for stocks to have that blow off top? Perhaps. So again, bonds are actually adding fuel to the rocket ship that are stocks. That's one of the potential outcomes, honestly. So I would keep an open mind. I would be cautious. And as far as 1998, 1995 are concerned, the economic backdrop was quite different. Mainly, the unemployment rate was on the downtrend, as opposed to today when we are on the uptrend. And as far as the 1970s are concerned, we don't really have runaway oil, all right? And kind of the correlations between inflation and unemployment were quite different. But again, by the time the unemployment rate went up, it actually just chopped the legs off of inflation, at least for the time being. Then, we did have another bout of inflation. But I do think that what allowed this to happen, we're really kind of lacking in this cycle. So I would tend to stay away from the overlapping and the overlaying of the 1970s to today. I think that this is the least likely outcome. I'm not totally discounting it, because you never know with markets. Anything can happen. But in my in my book, at least, the 1970s are the least likely outcome. I continue to look to 06 and 08, not because I'm thinking that we're going to have another Lehman Brothers or AIG or Bear Stearns. I just think that a lot of the prevailing narratives that we see today are more similar to what we saw in 06, 08, meaning rising inflation, the fear of rising inflation right here, and just the unemployment rate just slowly bottoming out and actually just doing what it does in a recession. I do think that this is potentially the most relevant example. But again, I just wanted to give you some other examples as far as history is concerned. So again, just to finish off, cautious outlook on stocks. Don't get married to rallies, in my opinion. These candles right here were very headline driven, in my opinion. And if you actually start getting, possibly some of that optimism gets sucked out of the room, not too good. Also consider some of the geopolitical developments. Again, it could also be a nothing burger. Nothing ever happens. We just press the nothing ever happens button, and India, Pakistan might be over with in a matter of a day or two. But I would keep that in the back of my head. All right. Excuse me. I'll leave it at that. If you like this kind of content, consider leaving a like and subscribing to the channel. And I'll see you next time. Bye.